All right, good morning, ladies and gentlemen. My name is Benjamin Goh. I am the head of research for SIAS. What we have today is an additional video on our long-running series on the bond market as well as bond funds in the Singapore market. So as you know, bonds are a very viable asset type, but most investors in Singapore are actually stock investors. So that's why we have this series of videos to try and educate potential investors of the bond market. We do have a selection of very good questions today, so I'm going to run through all of these review. And the first question that we have is, given the current volatile markets, what would you recommend to investors to counteract the volatility? So is a bond or fixed income instruments recommended to be part of the investment portfolio? So there are actually three general ways. None of them sound good, or rather the first two don't sound really good, but let me just run through it in the interest of covering all bases. So the first one is basically to sell everything and to hold cash. Now, as you can see, this is kind of like the nuclear button. Normally we don't do this unless it's a very severe crisis or we have got no clarity about what's going to happen in the market. But of course, as you can imagine, there are a couple of disadvantages of this option. Generally speaking, if the market is already going down and we are already in a crisis, it is unable, or rather investors are usually unable to exit their position at a favorable price, simply because the markets have already started adjusting to the unfavorable macroeconomic environment. The other problem with this option is that investors are forced to sell the stock of a company that may be fundamentally strong. So for example, if you identify a company that you think will do very well in the next 5 to 10 years, they're fundamentally strong, they've got a good business plan, they've got a good strong management, so on and so forth. But if you're going to be selling everything, including this company, then you might be just selling a company that will add value to your portfolio in the years following this crisis. Another problem here is that if you sell everything and you hold cash, then the next question will be, when do you reinvest your cash, right? That is, of course, a very tricky scenario, and some investors call it the process of trying to catch a falling knife, because you have no idea when the crisis will end. All these are really good reasons why we shouldn't be selling everything to hold cash during times of high volatility. Now, the second way to mitigate volatility is basically to hedge. For retail investors, this may not be a recommended approach, simply because hedging requires the short selling of derivatives or the buying of put options. Now, derivatives encompass two big asset types. These will be the futures contracts as well as options. And usually in the Singapore context, when you talk to a local broker, if you want to be investing, buying or selling derivatives, you actually need to have a separate derivative trading account, which is different from your stock trading account. So which means that you have to open two different accounts, maybe the same broker, you've got two different platforms. And mind you, whenever you want to trade derivatives, you actually need to fund it first. And there is always built-in leverage. All right, so for stocks, you don't have to take leverage if you don't want to. It is entirely voluntary. But in the derivatives trading account, derivatives markets, leverage is already built in to the product, the futures contracts as well as the options. Now, leverage, as you know, will amplify both losses as well as gains, and which means that a small move in the market will lead to big changes in your portfolio value if you do have derivatives and options inside your portfolio. So this is really not for everybody. And of course, the mathematics in terms of calculating the value of the futures contracts as well as options, the dynamics surrounding that is going to be very different from a stock, right? So hedging is probably not the most appropriate approach for most retail investors in Singapore. Now, the last method to mitigate volatility is the traditional method of diversification. All right. So at SIAS, we always preach diversification because we think that is a low-cost, easy approach for retail investors to try to lower the overall volatility of their portfolio. So what do we mean by diversification? So the traditional, casual definition of diversification is to buy a little bit of everything. So what we mean is you can invest in different types of markets. So Singapore market, Hong Kong market, US market, so on and so forth. Different type of sectors. So you can invest in financial stocks in the financial industry, banks, brokerages, insurance. What about transportation industry, hospitality, property development, technology, so on and so forth. So all these are different sectors. We're going to diversify, buy a little bit of everything, as well as different asset types. Now in Singapore, most investors are stock investors. So it is very easy for us to understand the stock market. It's very easy for us to trade in the stock market. But then stocks are not the only asset types available to us. We also have got bonds, which is the focus of today's video. All right. Now, before we get into the specifics of bonds, let me just tie off the discussion that we have here on diversification. Now, some people or some investors in Singapore don't quite like diversification because they think that it kind of dilutes away their opportunity to make capital gains in the stock market. But think of diversification as going to your favorite hotel or restaurant for a buffet lunch, right? So if you go for a buffet lunch, you've got all kinds of food, a different variety, and sometimes you might find something that you don't actually like. For example, the beef is not nice, it's not cooked to your liking, and of course you can choose the rice or the pork or the chicken or the dessert or something else, right? So the idea is that when you diversify and you have got a well-diversified portfolio, sometimes some of the things that you buy are not going to do well, but you've got other things in your portfolio that will probably do better, all right? So what we want to kind of focus on is really the average return of a portfolio rather than the return of any single security. Now, bonds actually fit very well in terms of the purpose of diversification, simply because they tend to be less volatile than stocks. And of course, they also tend to, given certain situations, they might move in the opposite direction of stocks, right? So this is what we call the risk on and the risk off. So risk on basically means that people on the market is willing to take more risk, and they tend to buy things like stocks because stocks tend to be more volatile. But then when the sentiment changes, people are risk off, the market is risk off, then they tend to sell their stocks and then buy bonds, all right? So given this kind of dynamic, the bonds and stocks can be thought of as slightly different securities, or rather securities which are at different spectrums of the volatility gauge, right? So so when the stock market goes down, normally the bond market might profit a little bit, all right? So what we want to focus on really is today on the bond market, okay? Now, bonds are really, they are really suitable for most investment portfolios, but they are particularly helpful for investors who are generally more mature, because if an investor is close to retirement or already retired with little salary and limited cash inflow, then of course the regular coupon payments from bonds can be used to pay for the investor's living expenses, all right? And also, generally speaking, bonds have got much less volatility compared to stocks, so that will also be very helpful for somebody who already does not have an income, because this person would not be able to stomach too much risk, too much volatility in her portfolio. All right, so again, in a nutshell, bonds are suitable for all investors, but are even more helpful for investors who have got very little appetite for risk, who already do not have a recurring income. All right. Now, moving on to the second question, what are some of the safer instruments investors should look at? So let's start off with the stock market. So of course, you can look at low beta stocks such as REITs, real estate investment trust funds. So these are basically trust funds which are listed on the stock market, and what they do is that they accept investors' money and then they will buy a portfolio of property, real estate. Okay, so generally REITs do not exhibit as much volatility as, for example, technology stocks or banking stocks. All right, but they are still part of the stock world, part of the equity world. Of course, the flip side is that if you look at the bond world, the fixed income world, generally, if you are looking at the sovereign bonds, as in bonds which are issued by governments or government-linked corporations, they tend to have even lower risk compared to any kind of stock. All right. So if we are talking about good quality sovereign or GLC, government-linked corporation bonds, they tend to be seen as more of the safer instruments in the investing world. And that actually provides a good introduction to our next question. So our next question is, for the retail investor, how should we select good quality bonds and where can we look for them? Now, this is a great question. There are a couple of features that all investors should consider when they look at bonds. And one of them would be the credit rating of the bond issue itself. So whenever a company issues a bond, the company can pay some money to the three big credit rating agencies, which is Fitch, Moody's, as well as Standard & Poor's. All these three big credit rating agencies are based in the US. Traditionally, if you want to have your bond rated, you can go to any of these three, and then they will look at the financials of the company, they'll look at the structure of the bond, and then they will issue a rating. All right. Now, when it comes to bond credit ratings, if you want to look for a good quality bond with very low risk of default, then of course look for the ones which are rated AAA or AA. All right, AAA is the highest level, the best quality bond that you can possibly buy that is rated by any of these three credit rating agencies. The AA is one notch down, so anything that's AAA or AA is pretty low risk. Okay. Now, you also need to take note of that there are two types of credit rating. The credit rating agencies can rate the bond itself, and you can also rate the company. All right. Now, for very big companies, they do have credit ratings for both the bond issue as a company itself. But for most other companies, excuse me, that may not be true. All right. So, but regardless, try to look for a bond issue. Try to look for a bond issue which is highly rated by any of these three credit rating agencies. Now, what are some of the other features that you should look for? Bonds issued by companies which are well known, with big market capitalization, which are considered blue chip, and which are components of the stock market index. Now, these are the kind of companies which generally are big, financially strong. They have very well developed sources of funds. They've got good relationships with the bankers, so on and so forth. These are the kind of companies which are generally more stable, right? And they are able to pay their debts, okay? So in a nutshell, we want to look for companies with this kind of features because they tend to have stronger balance sheets as well as better than average business prospects, all right? Now, the nature of a bond is that when you buy a bond, you are lending the company some money. And of course, after a certain amount of time, when the bond matures, you expect to get back your principal, all right? So, and of course, for the company to be able to pay you back your principal as well as you give you a little bit of interest in terms of coupon payments, they need to have good business prospects. So generally speaking, companies which are large, well capitalized, well known, so on and so forth, they've been around for decades. These are the companies which have got stronger financial prospects. All right, so try to look for these kind of companies to begin with before you look at these smaller companies. All right. Now, we've already spoken about this a little bit, but companies which are government owned or quasi-government, for example, Temasek, SIA, HDB, LTA, so on and so forth. These kind of entities do issue bonds from time to time, and generally they are very popular with investors because they are seen as having very, very low risk. All right. So one point to remember is that entities which are part of the government or linked to the government generally are seen as having very low risk. Therefore, as you can see, even in the very recent SIA bond issue, the one which is denominated in US dollar, those were oversubscribed by about 5 to 6 times, simply because SIA is seen as a very well-known brand, internationally recognized, and of course the Singapore government has got a significant stake in it. So, and therefore, the idea is that investors generally are quite bullish on this kind of companies. Right? So SIA bonds, GIC bonds, LTA bonds, for example, have always been very popular with investors. Okay. Now the second part of the question was where to look for retail bonds. Now, retail bonds can be found on SGX, the Singapore Exchange, simply because they are listed on the Singapore Exchange. Now, retail bonds, by definition, is that one lot of a retail bond is equivalent to Singapore dollars, $1,000. All right. Now, sometimes a bond can be sold at a premium. It can be sold at a discount. So the price will not be exactly 1,000 Sing dollars. It could be slightly more if it's sold at a premium. It could be slightly less if it's sold at a discount. But whatever the case is, retail bonds are listed on the Singapore Exchange. Now, the Singapore Exchange website does provide quite a bit of information on Singapore retail bonds. For example, it does have the current price or the last traded price of the bond, as well as the price history of the bond with a nice chart. And also on the SGX website, will contain announcements by the issuing company. For example, the company might say, we will be issuing the coupon payments next week. How much would that be? Or we are releasing our financial statements, so on and so forth. So announcements by the company issuing the bond will also be captured on the SGX website, along with any kind of corporate action, as well as the specific offer documents of that bond issue. All right. So your first point of contact whenever you are talking about retail bonds should be the SGX website. Now, something to remember is that some bonds have got special features. For example, the bond could be a perpetual bond. That means there's no maturity. All right. Or the bond could be a callable bond, which means that the issuing company can actually call back the bond after a fixed amount of time. So these will be some of the features that you will probably want to spend a little bit more time looking for, as well as scrutinizing before you actually buy the bond. Okay. So that will be for retail bonds as well. But of course, the next question would be, we do have two types of bonds in Singapore. We have the retail bond and we have the wholesale bonds. So retail bonds, you can find out information from the SGX website. You can trade it through your broker. Then what about wholesale bonds? Now, wholesale bonds, again, by definition, is actually meant for bigger investors. All right. So one lot of a wholesale bond would be equivalent to 250,000 Sing dollars. That means $250,000 Sing dollars. So it's quite a big chunk of change for any single retail investor. So that's why wholesale bonds are generally bought by high net worth individuals, companies, as well as other financial institutions. All right. Now, the thing you want to remember about wholesale bonds is that they are not listed on the Singapore Exchange. All right. They are actually traded OTC, over the counter. So which means that you need to pick up your phone and you need to call your broker. So the same broker that you have for your stock trading account, you just call this person up and ask this person to curate or give you a list of bonds available for trading in the Singapore market. All right, so you can't look it up in any kind of website because it's traded OTC, over the counter, right? So what your broker will do then is, of course, to ping or to reach out to the other brokers from the other banks to find out what bonds they are buying or selling. And then this broker, your broker, can give you a list of what's available to trade, and then you can look at the list, and then you can ask your broker the specifics of that particular bond that you might be interested in. Okay, and of course your broker would be, again, very helpful to help you find the offer documents for that bond, so that you can find out how the bond is structured, the commercial terms of the bond, when it matures, so on and so forth. Okay. Now, since wholesale bonds are actually traded OTC, the commissions may vary. All right. So it'll be best to check with your broker how much she actually charge for commission for that particular bond that you want to buy or sell. All right. Okay. Now, moving on to the next question, what is the difference between retail and wholesale bonds? So we've spoken a fair bit about it just now in the previous question. Let me just reiterate the differences. For retail bonds, one lot is equivalent to 1,000 Sing dollars. Again, it could be worth a little bit more or a little bit less, depending on whether the bond is traded at a premium or at a discount. The retail bond is traded on the Singapore Exchange, is listed on the Singapore Exchange, so which means that your broker platform, you can probably see it on the platform that you already have. Okay. Now, the challenge with retail bonds in Singapore is that the selection is quite limited. All right. So I just want to do a quick look at the list of bonds, retail bonds listed on the Singapore Exchange. There is CapitaLand, SIA, so on and so forth, but very limited selection, not too much to go on. Okay. What about wholesale bonds? The wholesale bonds, in contrast, one lot is equivalent to 250,000 Sing dollars, $250,000 Sing dollars, and again can be traded at a premium or a discount. And the only way to trade wholesale bonds is through your broker, because it's OTC, over the counter. So you actually need to contact your broker, just call the person up and check. Now, given that the wholesale bonds are actually traded OTC, there is really a huge selection of bonds out there for the Singapore investor. Now, just a little bit of background. Traditionally speaking, globally, even in the US and developed markets in Europe, UK, so on and so forth, bonds have traditionally been traded OTC. That's why you've got a huge collection. So this is, a legacy issue, it's a cultural issue. That is the way it has always been done. All right, so if you want to find more, some of the more attractive or interesting bonds out there, they are usually traded wholesale, which is $250,000 Sing. But there's a lot out there, hundreds. All right. So, and the only way to engage in this market, the wholesale bond market, is really through your broker. Okay. So these are the main differences between a retail bond as well as a wholesale bond in the Singapore market. Now, the next question that we have is a extremely good question. How would you evaluate bond funds? Now, in general, a bond fund is still a unit trust fund. Okay, so at the structural level, we're going to evaluate a bond fund just like any other unit trust fund. So some of the questions that you might have would be, who is the fund manager? So we're not talking about the person itself, we're talking about a fund management company. So are we talking about Nikko Asset Management? Are we talking about State Street? Are we talking about BlackRock, so on and so forth? So what you want to make, or what you want to ensure is that the fund management company, it's a well-known company, it's been around for a long time, and they have got a variety of different funds which they manage. All right. So this will be some of the first questions that you want to ask. The second question will of course be, what is the track record for the fund that you're looking at? And we're not just talking about the returns for the last week or the last month or the last year, really, because a unit trust fund, the returns are really for the long term. So what we should be more interested in is the track record of the fund for the last 3 years, 5 years, 10 years, or even 20 years, right? So for fund management companies like Nikko Asset Management, they've been around for a long, long time. All right, so they've got lots of data. All you need to do is to check their performance for that particular fund that they run for the last 3, 5, 10, 20 years. All right, and what you want to do is to kind of check the performance for this fund compared to their competitors. So for example, you've got two very similar funds by different companies. You want to check the performance of each of them and compare. All right, so make sure you, all things being equal, you want to choose the fund which has got relatively stronger performance over a long time. Now, given that we've kind of weathered a couple of major macroeconomic crises in the last few decades, it might be worthwhile to compare or to determine the performance of the fund during the great financial crisis of 2008-2009, as well as for the COVID-19 pandemic of, last year, 2020. All right. So what you want to do is look at the fund performance for those time periods. Take a look at them. Did the company or did the fund lose money? If so, how much? Was the performance worse than other funds, other similar funds, or funds from competitor fund management companies? So this will give you a sense of how well the fund managers are able to react in a major crisis. So it's always better to for a fund manager to lose less money compared to his competitors in a major crisis. So that's a good sign, it's a plus. All right. What are some other questions? So maybe you want to ask, what is the current AUM of the fund? AUM is asset under management. All right. So let me just put this in the Singapore context. Whenever there's a new shopping center in Singapore, you're probably going to check it out. And of course, during lunchtime or dinner, you want to go and find out, what's there to eat. So you might go to the food court of the shopping center, and then there are lots of stores, new stores, so on and so forth, stores that you have not patronized before. So the guiding principle, at least for Singapore Singapore eaters, people who go out to eat, is generally you want to go to the store that has got a long queue. All right. So even if you're not eaten in a store before, you see a store with a very long queue, and next door you have a store with no queue, you're probably gonna try to buy from the store that has got a long queue, because by definition, long queue, it has to be good. All right. Now, using that similar idea, when you look at the fund's asset under management, if you got two very similar funds that have got similar exposure, both of them are bond funds, both of them look at the same type of bonds, so on and so forth, then generally speaking, the fund which is far larger, that is probably your first choice. All right. So if you look at a fund with $10 billion asset under management versus a fund which is $100 million asset under management, you probably want to look at a bigger fund. All right. So try to compare the current AUM of the various funds that you are evaluating. Then, of course, price is also a factor. So what is the annual management fee that the fund managers charge? What is the overall expense ratio? So again, this question is tied to the previous question. Generally speaking, when a fund's AUM is large, the annual management fee is relatively low. The expense ratio is relatively low. All right, so you can kill two birds with one stone by looking at funds with, which are generally quite large, because they generally come with relatively lower management fee as well as expense ratio. Okay. Some other things you want to consider if we are talking specifically about a bond fund, you might want to ask, how are the coupon payments handled? So a bond will issue coupon payments once every 6 months. So are those going to be given out to investors as cash, or are those going to be automatically reinvested into the bond fund as additional units? Okay, so if you're an investor who has invested in a bond fund because you need the cash for your living expenses, then make sure you choose one that actually pays out the coupon payments as cash. All right, so this is quite important because there are quite a few funds out there that automatically reinvest the coupon payments or dividends, if you're talking about a stock fund, automatically as additional units. All right, so do check the offer documents to confirm how they actually handle the coupon payments. Okay. Then of course you want to consider what kind of bonds, the actual bonds that the fund invests in. Are we talking about sovereign bonds, which are bonds issued by governments, government entities, government-linked corporations? Are we talking about corporate bonds, that means bonds which are issued by companies? Or are we talking about high-yield bonds? High-yield bonds are generally bonds issued by companies which are not so strong financially speaking, and therefore they have got relatively high coupon payments to incentivize investors to buy those bonds. All right, so different types of bond funds actually invest in different types of bonds. So again, do check the offer documents to find out what type of bonds. Now, generally, sovereign bonds have got the lowest risk, got the highest bond credit ratings. High yield bonds are the direct opposite. They've got the highest risk, relatively speaking, and the lowest credit bond ratings, relatively speaking. All right, so you want to kind of check that as well. It will also be perfect or best if the bond fund also lists out the actual names of the companies in which they buy the bonds. So if the bond fund actually has got LTA bonds, those kind of bonds are generally quite safe because they are highly rated and have got very low risk. All right. And of course, the last question that you want to ask is, are those bonds issued by Singapore companies or overseas companies? Now, obviously, overseas companies, if you buy, or rather the fund actually buys those bonds, then there will be some kind of currency risk, right? So that's again something to consider, because currency risk will eventually factor into the returns that Singapore investors get by investing in those bond funds. Okay. Now, we have gone on for quite a fair bit, and we have covered quite a few important questions. Hopefully, these will be helpful to you, potential investors of bonds or bond funds in Singapore. And again, do look out for further videos that we have on various topics. Just a little bit of friendly reminder at the end. If you do want to keep in touch with SIAS or be on our mailing list, do sign up so that you will get regular updates as well as notifications whenever we come up with new videos, content, or seminars, presentation materials, so on and so forth. All right. So thank you very much, and hopefully this has been a very helpful video for you.